to attach distributions from ILIT. Avoid gift taxes. The contributions by the grantor to the beneficiaries are considered as gifts. If you want to avoid gift taxes, it is important that the trustee notifies the beneficiaries above the right to withdraw. The letter notifies the beneficiary's right to withdraw for a 30-day period. After the 30-day period, the trustee will be able to pay the life insurance premium using the contributions. The transfer for the annual gift tax can be excluded as the letter makes the gift a present instead of future interest. This helps avoid the need to file a gift tax return, leaving assets to minor and ensuring responsibility. Minors are not equipped to handle large amounts of money and assets. An irrevocable trust will allow you to put restrictions in place to protect the assets. Restrictions such as the beneficiaries reaching a certain age to gain access to the assets can be put in place. The creation of a trust will help you ensure responsible and behavior from adults or minors with reckless spending habits. The trust is supervised by an appointed trustee. The assets will be distributed as per the grantor's wish. This provides asset protection for the beneficiaries. As ILITs are not owned by the beneficiaries, the assets are protected even if there is a future litigation involving the beneficiaries. Linking the assets to the beneficiary is difficult. This prevents creditors from assessing the assets. Government benefits. Trust beneficiaries receiving government aid are protected with the proceeds received from a life insurance policy purchased by ILIT. The trustee will be able to control how trust distributions are used. This is done carefully so that it doesn't obstruct the beneficiary's entitlement to get government aid. Legacy planning. The generations keeping transfer tax stipulates a 40% tax on transfers and gifts is trust. The tax is also applicable when the gift or transfer is made or unrelated persons more than 37.5 years younger to the donor. Related persons who are more than at least a generation young than the donor will also be covered as per the tax provisions. Donors gifting assets to grandchildren instead of children is a common example. ILIT will help the grantor leverage the generations keeping transfer tax exemption. Gifts to the trust are used to fund and buy the insurance policy. As the death benefits proceeds are excluded from the estate of the grantor, multiple generations of the family like children, grandchildren and great-grandchildren will be able to benefit from the trust assets. Downsides to an irrevocable life insurance trust. There are certain tax benefits that become applicable only when the grantor lives 3 or more years after transferring the insurance policy to the trust.